drug maker Sun Pharma reported around a 23% increase in operating profit year-on-year for the quarter ended September. The Mumbai-based company beat estimates as it saw a pickup in sales of generic drugs and benefited from soft raw material prices and lower interest cost. But what came out as a surprise is that the numbers were driven by specialty products and improved performance in the international markets. Among the positives for the quarter was the launch of Ilumya, a drug for plaque psoriasis in Japan, which was well received. International operations did sequentially improve sales in Q2 FY21. Emerging markets and API sales improved it on a year-on-year basis. US business, which is 29% of sales, got a boost from specialty products, pushing sales to pre-COVID levels in certain categories. India business, which contributes 30% to sales, was steady, wherein chronic portfolio continued to grow stronger, offset by a decline in acute category of therapies. R&D expenses are expected to inch up further as clinical trials pick up. It has increased to 7.2% of sales, which is close to the long-term run rate. Investors need to watch out for the ongoing compliance issues with the Halol plant, which contributes 3 to 4% of sales. Management points out that there might be a virtual investigation by the regulator and the timeline is difficult to predict. The US elections is also the key event to watch out for. The sequential improvement in US specialty is comforting. Foray into Japanese market remains a key watch. Meanwhile, India business is expected to remain steady as it has around 50% contribution from chronic therapies. But on a longer time scale, when we look at the company's performance, EBITDA margins have sharply contracted over the last 5 years. This is mainly on account of high investment behind specialty business, which requires disproportionate R&D and marketing spend. But India's largest pharma company has a strong balance sheet with near zero net debt. It has a strong product offering in the US market and the management is hopeful of EBITDA break-even for few specialty products next fiscal. And thus, operating leverage should kick in from FY22 onwards. Valuation is still not inexpensive at 13.4 times of expected FY22 EV EBITDA, around 15% consolidation from the recent peak. But we do see improved trade sentiments from the stock post result. In our opinion, sustained traction in specialty would be key re-rating driver.